Good evening. This is Ken Long from Tortoise Capital with another trade of the day for April 25th, 2013. This one is looking at TNA, a triple leveraged Russell 2000 case study, and we're going to be examining the ideas behind the regression line crossover pattern trade that features how to stalk continuation patterns after a successful trade, and then when to shift to a trade in the other direction. So let's get started. Well, what we had on the 25th of April was a continuation of the gains from the 24th. We've actually had pretty much a rebound from oversold conditions all week, and the 24th yesterday was a strong move up, and it continued right from the get-go on the 25th with a little gap up here, and then you can see the VWAP little stair-step function here getting better. Well, this gap up opening, a gap and go, enabled us to cash a couple R in the morning trade on a nice move from 42.20 up to almost 43.20. So you had this really powerful move up, which confirmed the previous 4 days of uptrend, and still with room to go. We're still got a long bias here for the market to go retest previous swing highs and beyond. There's plenty of room for that to continue to go even past the swing high, and so we've got a long bias for the day because of that strength in the markets. So what you have is what looks like the developing this long sideways quiet channel, albeit with a slight downward twist here. Notice the Bollinger Band pinch here at just after 11. And so the chart is marked up, and in the usual way, the dark blue is Bollinger Band 30 plus or minus 1. The floodplain, we call that the river. The floodplain is the lighter blue on the outside. That's Bollinger Band 30 plus or minus 2. The red line is the Bollinger Band mean. Black line is the 30-period moving regression line. Thin blue here is the 10-period regression line. This is the volume-weighted average price. So the question was in our chat room, why not take this short here in the blue circle? To which I say that's an absolutely reasonable idea for this short. But your hypothesis is that the VWAP is going to fail, and if it does, you would reasonably say it could go back and test the open down here at 42.20, and so that's not a bad posture to be in. It's made a series of lower lows, higher lows. The river is starting to slope down. Absolutely perfectly reasonable idea to test that hypothesis, provided that you're not trying to be right and you respond to price action in the way it happens. Because the other interpretation for this is a long sideways failure to fail, holds support at the VWAP, bounces and is going to continue to go for another leg up, just like the leg we saw this morning. So that one is also very strong possibility. So what you have here is a critical state, something that can work in both directions with sharp moves that'll cause a lot of pain on half the market, and so that makes this a perfect place to be interested in trading. So if you take this short when price ribbon leaves the river, or not later than price taking out the previous swing low, you'd end up getting short in this little bump, but within about 2 to 3 minutes, this thing is reversing and taking off to the upside again. And then you'd say, well, it must have found support at the edge of the river, and now I want to play the long side. If you do, this trade already to the upside is paying for any money you might have lost on the downside here, and you're still well postured, and it's getting ready to take off above this triple high over here. So this is a perfectly satisfying short to take, but you have to take the signals as they come, and so this failure to fail turned into a reversal, and then you've got to take that signal too for the same reason you took the first one. And if we step back and look at the longer picture here, the reason that we're really interested in this long side is that this is now looking at 15 minutes in the last 8 days. And you can see this was this morning bump up and then into the sideways quiet channel and looking to continue. On the 15-minute charts, it looks like finding support at the edge of the river and starting to break out to new highs after a temporary RLCO. But that's part of a 3-day upward move coming out of finding a solid base of support here, where the market failed to fail further after the Boston bombing. It found support at 37.50 and now has just been running straight up, $5 on 37, on 35. That's about a 15% move already. Well, and that followed this downward pressure caused by the Boston bombing, and then it found support, and now it's really starting to unfold, and it's going to go back and test previous swing highs perhaps. So that's why we're interested in the long side, but by the same token, the very outsized nature of the move supports the idea of a 50% retracement in here, and that's why that short trade was absolutely legitimate, but you can't stick around there. You can't make it work. You have to respond and adapt to the prices that you see. So continuing on, this is what that short would have looked like. And if you got short here around 43, with a 10-cent stop above the Bollinger Band mean or a 20-cent stop above the river, this one gets all the way down to 42.90, and you either have a half an R or a full R in hand, and then you get this reversal from outside the floodplain, and now you have to exit not later than this regression line crossover with the ribbon re-entry, and in which case you're probably scratching this trade, or you may have managed to keep a half an hour depending on how quickly you decide to get out of that. But the main point is that this regression line crossover, which has given you the indication that that trade isn't working on the short side, is enough information to start getting long on this one, because of the previous idea of finding support at the bottom end of the river, is a perfectly consistent with the idea that this is going to take off and go another leg to the upside. So in the chat room, the way you traded this was with an entry here at the Bollinger Band mean, and we end up taking a long position here, and then exiting it around 43.24. So now what we're interested in seeing is where can this rascal find support at, because this is still consistent with the long side trade of finding support and then playing a continuation pattern. So let's take a look at that. So here's that trade with the entry at the Bollinger Band mean after reversal down here, and taking that exit in here. Now, right after the exit, it turns around and takes off again. Didn't chase it. Didn't feel like it had another leg up, but it did. And so once it gets away from us, if I can't re-enter here at 43.28, I just have to let it go, and I couldn't. So now I see the regression line crossover. In the first place I expected to find support is at the edge of the river, but it didn't. It failed right through, and now I'm stalking it here in this blue circle, and I frame the trade in potential trades in the following way. To quote myself here, now stalking this one to see where I can try to get long rather than trying to short this, even though I acknowledge that there was an RLC over here. That the expected move is simply back to the Bollinger Band mean, and in an uptrend it's very hard to make a living out of that. So what I'm really interested in doing is looking to see where it may find support and then continue. So the first place would be at the edge of the river, but it didn't. Then in the middle, then between the edge of the river and the Bollinger Band mean. So at this point, it wouldn't surprise me if it takes off, and I would buy that. If it comes back to the Bollinger Band mean, though, and finds support, I'm willing to buy that in the same way that I bought the takeoff from the Bollinger Band mean here. But if it doesn't hold support there, then if it held support between the mean and the southern edge of the river, I would be willing to buy that. That's still consistent with an upside move, and that would be a lazy W. And the last place that I would look for it is at the bottom edge of the river, in this case around 43.06. If it came all the way back here, I would be willing to buy it again, because once more, that's consistent with buy strength on dips, and all of those are places that if it reversed, then the uptrend is still not violated. However, if it fails outside of the river, if the ribbon comes all the way through the river. Then 3 places I can think about getting short instead of looking for continuation patterns to the upside, but places I want to start thinking about getting short is either immediately upon breaching the river, or maybe taking out this ribbon swing, this low from this ribbon here around 42.97, or the working swing low at, and certainly not later than 42.92, because that would have invalidated this entire package. So that's how I'm thinking about the shift in psychology from looking to buy strength on dips and for the continuation pattern, or actually thinking that that might be a new swing beginning to develop. Well, what had happened was, in fact, shortly thereafter, I interpreted this as finding support at the Bollinger Band mean, and what we had was the universal entry sold off on a red bar, then closed a green bar with a higher low, and then I buy the open green bar when it takes out the previous one's high, provided that it also has a higher low. So 2 higher lows, a couple green bars, taking out the first green bar. That's this entry here at 43.24-ish. And now what I hope you can see is that's consistent with that buying strength on dips. Well, shortly thereafter, we buy this reentry here. It gets up to the edge of the river, hits the 90 period or the 30 period regression line, and starts rolling over. It comes back, and when the ribbon goes below the Bollinger Band mean, I decide to exit. Why? Well, because it had an opportunity to get out of the river, and it really couldn't. It got bounded by the 30 period regression line, which is now rolled over, and you can see how powerful that is in determining these shorter term trends intraday. And it had made a lower high, and so I'm not sticking around, so I end up scratching or taking a micro loss on this. And now this did exactly what it was supposed to do. From the regression line crossover, came back and has been hovering at the Bollinger Band mean. You can actually see the Bollinger Band mean in the river starting to roll over as a consequence of this failure to make a new high. So now we're taking a look at a shift in orientation that when it fails here, so this was the first trade up, stalking, bought it, it rolled over, end up scratching that trade, and now shortly thereafter it comes all the way down to the edge of the river, rebounds, fails at the Bollinger Band mean on the short side, and now the 30 crosses the Bollinger Band mean, and now what we have is this. We have that previous support level that we looked at, and the price level at which we said I would shift from that long side buying on dips to the potential of a reversal. Now in these blue circles, you have at least 2 opportunities to get short at the right time, which is violating that previous swing low, and now price ribbon leaving the river with a declining in the 30, and you have to get short not later than this red line, because now you would have made a second new low. You have the beginning of trending behavior, and now with a short position somewhere around 43.14, you have an uninterrupted run straight down to 42.55. And that's, you're talking 70 cents. And if you're using one of these as your logical stops, that's a 10-cent stop, or that's a 20-cent stop. And so now you've got a trade that's in the money simply by responding to the hydraulics of the situation here. So the question in the chat room was, well, what's the difference between taking this first short that we took a look at, which I suggested is a perfectly reasonable short, provided then you then cover and stop and reverse and go long in order to get with the primary trend up, because that trade from the blue circle up into here is going to pay for that failed short. So the differences between those two are not really significant. In fact, you should take both trades. No significant difference between the setups. The only, if I had to find a difference, I'd take a look at this indicator here and say, look, the memory of this powerful move up here says you might not want to take that short. But I say take the short. You could have that 50% retracement, which is essentially what this second move is, and you don't know that it's not going to happen there. But if you take that short, then you've got to stop and reverse here, just like you're supposed to, for the same logic, and that is that this trend is now a continuation of the previous uptrend, and this is a long side trade with a buy on dip. However, when it fails to perform, just as shown on the previous chart, you've got to get short in here, or at least think about getting short. And now the two patterns are the same. When you have price rolling over, lower highs, lower lows, the ribbon leaving the river, both regression lines leaving the river, and now you have the beginning of trending behavior, and now you've got this move, which if you're using our normal stops is going to get you anywhere from 2 to 4R on a single position, and now without really violating the upside. This is longer term, that'll be seen as a buy on dip. But the main point is you got to take both trades, or in this case all three trades: the first short, the stop and reverse long, and then eventually this short side trade over here. So that's Ken Long from Tortoise Capital with another trade of the day for April 25th, and some ideas about regression line crossover, stalking continuation patterns, and then when do you shift to a new orientation. And I would argue that pay attention to these crossovers on when the 30-period regression line crosses the Bollinger Band mean and then crosses the Bollinger Band mean. Just pay attention to what happens after that and see if you can start gaining some additional insights. So keep your powder dry and your risk measured. Thanks so much for your attention.